Hello and welcome to this AFM pre-September 22 mock exam debrief video. And this is on question 1 and it's Durango. My name is Alan Lynch and I am your expert tutor. I'm working with ACCA. We're going to talk you through how to prepare for your ACCA AFM exam going on from September, which is including the 20 professional marks. The AFM exam is still relatively straightforward in your process. I know it's a complicated exam, but there's certain things that if you stick with them and if you concentrate on doing the basics really well, it is an exam you can do very, very well in. Some of the basics that you always have to keep in mind. The first one is time management. You're getting a lot of time back or extra time in your 3 hours and 15 minutes for your AFM exam now that professional marks are taking up 20 marks of the exam. So you're only completing 80 technical marks. That's a lot less than it was beforehand. And I think the questions that you'll see in the September 22 mock exam do reflect that. And that's a real opportunity. So managing time should be easier. But that doesn't mean that you can go, oh, I've got lots of extra time. You should still manage your time quite closely to the way you used to. I would still say that if it's a 10-mark question, you should be looking at about 18 minutes. And you have that buffer of time if you wanted to add anything later on, check through your calculations. We know sometimes you might get a bit confused in the calculations. So time management is really important. And it's important that you allocate the amount of marks to the amount of minutes and you don't go over that per question. You never look at a question like question 1 and say, I have an hour and a half, I'll go. You need to break down that 90 minutes into smaller chunks of time. So if the first part is 5 marks or 10 marks, you're breaking it down into 7 or 8 minutes or 15 and 16 minutes. And a failure to do that will just mean that the 90 minutes will disappear and you really won't get the benefit out of that extra time and the professional marks. The second part is that AFM, you still cannot pass without good narrative answers. So the narrative answers are really, really important. And without those good narrative answers, all of the effort you've made in your calculations just won't get you through the exam. So it's very vital that not only are your calculations good and they take the amount of time you're given in the exam, but that equal concentration and effort are made around your questions and your answers that are narrative based. And even in the Durang question, doing the report, it's really important that that narrative is good because that's where you're also getting a lot of your professional marks from. It's always important to read the question carefully. Don't answer the question you think you're being asked. Make sure that you do understand what the examiner is looking for. And you're answering only that, providing additional information, telling the examiner everything you know about a certain topic. When it's not related to the case study, it's all a waste of time. They can't give you marks for that. So really concentrate on the requirements, find out exactly what the examiner is giving, think about what amount of marks and effort you need to make with the time allowed, and apply that simple formula. You will not go too far wrong if you do that. And finally, using the CPE tool, as we're going to do in this example, is really, really important. And practicing and building up a structure and a strategy around your exam, knowing when to have your different screens ordered in a certain way. How do you get access to the exhibits when you need to? I will show you my strategy today. It's not the only one, but it possibly is one that you will adopt, or you will do your own version of it. But knowing that you have a strategy is one thing. Practicing it over and over again is the key part of having any strategy. So now we'll move on to the question and we look at it in more detail using the September 22 mock exam and using the ACCA CPE portal. So now we're going to get into the question detail of Durango. You're used to seeing this layout on the front. So you have the exhibits 1, 2, 3, and 4. That's a very common layout and that's just initial information. So the first thing we're going to do is think about your strategy. Remember I mentioned that? So if you look what I'm going to do, I've already got the word processor ready and my spreadsheet ready. As you can see, the word processor is on the right-hand side, the spreadsheet's on the left-hand side. I'm in a position to open up my exhibits and I can put them either with the spreadsheet or with the word processor and use the other one. Again, my screen will never be too cluttered. So the first thing I'm going to do here is I'm going to open up my requirements. I'm going to highlight them all and I'm going to copy them in like I have done here to my word processor. That means that's one less window to open, but also all the way through your question, you're constantly reminded of the requirements you're trying to hit. So what are the requirements we have? Well, the first one is to discuss how real options theory can be used alongside net present value to help companies with their investment decisions. Pretty straightforward theory-based question. Second part, prepare a report. Your head should already be thinking layout of report, professional marks, calculations, talking about your calculations. You should already be singing the obvious things. Part one is calculate a suitable weighted average cost of capital that your rank can use to discount the Frontland project cash flows. Part two is estimate the net present value of Frontland project in dollars, ignoring the value of the follow-on project. The third part is estimate the value of the follow-on project in dollars using the Black-Scholes option pricing model. And finally, the fourth is discussing the assumptions made in the above calculations and any further factors that would need to be considered before making a final decision on whether to go ahead with Frontland. And then you're told about those key 10 professional marks, and I'll talk about them in a second. So you have 90 minutes to answer this question. Now, those 90 minutes are now split over 40 marks rather than 50 marks, because if your approach is correct, you will pick up those professional marks as you go through your questions. Don't get too relaxed with that time. I would still recommend that you try and keep normal time than you would have done before they were extended to professional marks, then use that time accordingly or to review your work at the very end. So we're thinking about part A, 6 marks, about 11 minutes, and then move on to the next part. So what's the first thing I'm going to do? Well, the first thing I'm going to do is go through my exhibits. We see here Durank is a listed refrigerator manufacturing company based in Meudon, a Central European country whose currency is the Meudon dollar. Is considering expanding by setting up a new factory in the neighbouring country of Frontland, where the currency is Frontland Florin, or FF. That's a little background information that you're going to need to know. But it really is the next 3 exhibits that are going to be key. The first thing that I would do with my exhibits, I would try and tidy them up a bit. I would make them fit into a nice, neat window. So if I'm using them, especially using them for my Excel, I can put them over the right-hand side and use them to access them. So number 2 is Durank's capital structure comprises 200 million shares at $3 each and 100 million nominal value bonds trading at 110 per $100. It has an A-rated ranking, or A rating according to the biggest credit rating agency in Meudon, and this corresponds to a credit spread of 55 basis points. And it's expected to stay unchanged as the company expands into Frontland. Durank has never operated in Frontland before. However, one of its competitors, Clunish, expanded there a few years ago and now operates successfully. So that's going to be the comparison company that Durank is going to use. The directors considered that the systematic risk facing Durank as it expands will be comparable to that facing Clunish. Clunish has an equity beta of 1.57 and the debt beta is assumed to be approximately 0. It has 100 million shares in issue, each trading at $2.40. It also has $75 million of bonds in its statement of financial position, and they're trading at $106 per $100 nominal value. We assume that both Clunish and Durank pay a tax at an average rate of 30%. The risk-free rate of interest is 3%, and the equity risk premium is 5%. Moving on to our third exhibit, again, get that ready, make that a little bit easier to use when you're doing your question a little bit later on. Because again, this is all information that it's easier to have at your fingertips. And again, you can access them on the left-hand side at any stage. The finance director has prepared the following 4 cash flows. And you can see units to be sold. You have revenue, cost, investment, residual value. You have information on exchange rates. Nothing that should be that unusual. You have information on component costs. The new factory business in Frontland will need to purchase a component from Durank to incorporate within the refrigerator. Durank has agreed to fix the price of the component at 50 cents per unit, produced and sold. The cost of this component should be treated as a tax-deductible expense in Frontland, and the contribution generated in Meudon, which is 40% of the revenue earned, should be treated as a taxable income. When we look at tax, the tax rate in Frontline is 10% compared to 30% in Maydonk. Tax are payable in the year as the liability arises, and losses can be relieved in the same year. A bilateral tax treaty exists between the two countries, and all net cash flows arising from the project will be remitted back to Durank at the end of the year. So all that means is that the difference in the tax rates needs to be made up by one or the other company. And then finally, our last exhibit. The Durank directors have closely monitored the investment Clúnis made in Frontland and watched how the investment was supplemented by follow-on projects. They consider that if Durank's initial investment project is successful, a further investment of $10 million in nominal terms after 4 years could enable the company to generate the following post-tax free cash flows. Again, they're forecasted. And we see year 5 to 8. And the volatility or standard deviation associated with these cash flows has been estimated to be 20%. And we talked earlier about the Black-Scholes model, and obviously it's in your response options, you're expecting to use it, and some more of the information is available there. So what are we going to do? So we've looked at our exhibits, we've considered what our requirements are. Now we're just going to have a quick look at our requirements about what's expected. So again, part A, the real options. 6 marks, 6 solid points, 1 to 2 lines each, and move on. Remember, if you're at a stage in this question that you can think of 4 out of 6, we talked earlier about keeping those professional marks time a little bit at hand. Don't sit there and worry about the other 2 points. Get your 4 down and move on to the next question. At the end of the day, if you got 4 out of 6, that's still a good ratio to start with. If later on you're working on the calculation or something and some of them pop into your head, just jump in, make that point, just a one-liner to remind you, and you can go back and finish your sentence a little bit later. But don't let the questions for 6 marks drag you back. 6 marks, 10 or 11 minutes, move on, put everything you know, don't worry about what you don't know, and again, you might be inspired a little bit later when you're a little bit more relaxed. Part B is prepare a report for the board of directors. Now we see that's down in part 4 of B, and we'll talk about that in a second. But what are the things that come straight to your head? Well, it's a report, so it has to be a headline report. Who's it to? Who's it from? What's the subject? It must be a story. It must have an introduction. It must have middle sections, and it must have a conclusion. And they're key to your professional marks, as we'll see in a minute. The other parts of A or B, parts 1, 2, and 3, they're pretty standard calculation questions, and we'll go through them in a few minutes. And then number 4, we talked about discussing the assumptions. So if you look here, there's a couple of parts for part 4. Discuss the assumptions made in the calculations and any further factors that would need to be considered before a final decision. You also need to provide what that final decision is. So you comment on the numbers calculated, you talk about the assumptions made, you look at the other factors, and you contribute your final advice. Now let's have a look at professional marks. Your professional marks are split into 4 for this question. So what do they mean? And there's often confusion about what exactly they mean, and you can get caught up in the theory of professional marks. So let's have a look at what you need to do in this question in order to gain some professional marks. The first one is on communication. You have a report structure, and we talked about report structure, your style and your headings, and using bold for headings, just those simple things. Your clarity and presentation of calculations, and we'll go through that in a few minutes, and how your answer is focused on the scenario provided. We look at analysis and evaluation, the use of data for the calculations, using the appropriate data provided in the exhibits to draw conclusions, and looking at further analysis or other considerations that are relevant. When we consider skepticism, sometimes the hardest professional skill for people, but it's just a bit challenging. So talk about the information. Do you have everything needed? Do the assumptions make sense? Can you probe, or can you notice something that's missing, that if we had this information, the company would be in better shape or would be in a better position? And finally, commercial acumen. Identify the external constraints and the opportunities. So don't try and concentrate on what communication and what analysis is and what skepticism is, because that will eat into your time during your question. What you need to have is just a general understanding of what these professional skills are. But if you're probing, if you're constantly asking why, if you're constantly referring back to the case study, if the information you're provided is very specific to the case, you're answering professionally, you're avoiding bullet points, your layout is good, you will get a good chunk of your professional marks along with all of the other marks. So certainly don't let it eat into your time. You need to build professional marks into the way you write, into the way you structure your answers. And if you do that as part of your practice, like I've done today, those professional marks will come really straightforward. It'll be very easy thing to get in your exam. And therefore you don't have to assign time to it. It's just part of the way that you answer questions. So let's look at part A, how real options theory can be used alongside net present value to help companies with their investment decisions. I mentioned earlier 6 quick points. Again, these answers are very well written and they're very well considered. I wouldn't expect that your answers have to be as detailed, but it's going to be what's your point and what's the relevance to this case. And if you can make sure that each point you have is relevant, you're going to pick up those marks. As I said, if you can only think of 3 or 4, get those down, move on, and then at a later date, you can come back to the rest of them. So investments are most commonly appraised using the net present value approach. Don't be afraid of stating the obvious because that's the starting point. Net present value calculates the theoretical absolute gain to the shareholders if a project is undertaken. And again, it aligns with the primary objective of financial management. However, net present value assumes that the investment decision will be made immediately or not at all. And then once it is made, it cannot be changed. Again, real options recognize that many investment decisions are more flexible than this. And in fact, it's the reality. For example, some projects can be delayed to give management a chance to see how the environment changes. Some projects can be adapted after investment to incorporate other options. And again, we're talking about follow-on plans here today or other expansions. Using real options theory and the Black-Scholes options pricing model, the flexibility can be valued and added to the results of the net present value analysis. And that gives a better value of the picture. And again, this is all leading into what we're going to be covering in part B today. The key is that if the real options give any positive opportunities, they can be exploited, whereas downsides can be ignored, such as options being allowed to lapse. And in some cases, a project that initially looks to be financially unviable, but which gives you a negative net present value, can actually be acceptable once the value of real options is also incorporated. And maybe we'll have a quick look out for that today. So what you should do first in this question, and be very careful with time. So your 7 marks here, you're looking at, let's say 12 minutes. And you really need to get this down and be looking at the clock you're in the room or on your computer or on your watch, whatever way you're used to tracking time. Your computer's right in front of you, has the time. It's the easiest way. Look at your 7 marks, look at those 12 minutes and go, okay, how do I calculate a suitable weighted average cost of capital that Durant can use to discount the Flatland project cash flows? So I'm going to take you through. So I've done this in advance. So what I'm going to do is I'm going to show you how I did it. I'm going to show you how to use the spreadsheet tool effectively. And then you'll also see the explanations in red. Those explanations in red are for you to follow the video, maybe stop it, maybe work it through yourself at a later date. If you're not too sure where any of the numbers come from, they can all be tracked back to the exhibits. So don't you worry about that. And then what we're trying to do, and then I'll show you the calculations. You do not need to include the writing in red in your exam. I'll show you going through the question how I've built in my calculations within the numbers. The examiner will be able to see all of that. So again, the red writing is for illustrating how I came up with the answers and for you to look back at the video later. You are not required to do that in your exam. It's just going to waste your time, unfortunately. So first of all, we're going to open up the cost of capital, or exhibit number 2. And we've been suggested to look at Clunish Company. So Clunish has 100 million shares in issue, each trading at 240. So the value of equity for Clunish is 100 by 2.4. Again, that will appear in the calculation. You do not need to explain it on the right-hand side. So that gives you 240 million. The value of debt, so here they have 75 million of bonds, as you can see in the exhibit here. in a statement of financial position, and they're trading at 106 versus the 100 nominal value. So it's a 75 million of bonds multiplied by 106 divided by 100. So they're basically trading at 6% higher, and that's the market value. Your asset beta then is the equity beta that Clunish has of 1.57. The debt beta is assumed to be 0. So you have your 1.57, and what I have done in here is I have linked my calculations to previous cells. Why have I linked them to previous cells? Well, if you make a mistake, let's say in the value of equity that you notice later on when you're checking your work, if you have typed in all of the numbers, you have to go and recalculate every single number. But if that let's say I put 200 million in there earlier, and now it's 240. If I have linked it in a similar way that it's 1.57 multiplied by B6, and we can see in the red writing here, that's the 240 billion. If I put 200 in there by mistake and I realize at 240, I only have to change the 240 and it'll have a knock-on effect and correct all the other numbers automatically. So it's a great habit to get into. So it's the 157 by the 240 divided by the 240 million, which again is the value of equity, plus 0.7, and 0.7 is the tax rate. So we know the tax is an average rate of 30%. So it's the tax rate of 31 minus 0.3, which is 0.7, multiplied by B7, which is the value of the debt. So again, value of the equity divided by value of the debt, and the asset beta then is 1.27. Okay, now we do this something similar with Durank. We know that Durank has 200 million shares trading at $3. We know the value of the debt is 100 million of debt, and the bonds are trading at 110 over the nominal value of 100. So again, it's the 100 million of bonds multiplied by 110 divided by 100. And then your equity beta that's re-geared. And when we talk about it being re-geared, because the equity or the debt ratio is 0 earlier on, so we're re-gearing it. So we're starting with the asset beta of Clunish of 1.27, as we are told that we have to use that as a proxy. So we take the 1.27, we multiply that by the 600 million of equity plus the value of the debt, which is 110 million multiplied by 0.7, because obviously we're removing the tax portion of the debt, and just moving this over slightly, we're dividing that again by the 600 million. So look at cell B11, which is the equity, plus 0.7 multiplied by the 110 million divided by the 600 million. And we get 1.44. So we have an equity beta of re-geared, which is 1.44. So hopefully this is beginning to make a little bit of sense. This might be a little bit different to the PDF answers that are available because we're using exact Excel. Now we're going to calculate the weighted average cost of capital. So the CAPM model we're going to use to calculate your rank company cost of equity. So first of all, what is the cost of equity? Well, we know, again, back to the question, that the risk-free interest rate is 3%. So we start off at the cost of equity being 3% in our calculation, plus the 1.44, which is the equity beta re-geared that we've just calculated, multiplied by 5%, which is the equity risk premium, again, provided in your question. So once you know your formulas, this question is actually pretty straightforward. We're going to use the A rating credit spread, which we're told is 55 basis points. So the cost of debt is 3%, which is the risk-free rate, plus the 55 basis points, or 0.55%, which is the credit spread. So our cost of debt, excluding tax, is the 3.55 multiplied by 0.7, which is the 1 minus 0.3, which is taking into account of your tax. And then to calculate your weighted average cost of capital, it's your 10.15 or 19 here. We're going to have just slight differences because of using Excel exactly, multiplied by your 600 million. Remember, your cost of equity multiplied by your value of the equity divided by your total equity plus debt, which is the 710 million, plus the 2.49, which is the cost of debt less the tax, multiplied by 110 million, which is the value of the debt, divided by the total of the equity and debt. Weighted average cost of capital at this stage should flow right off. And now you've got your weighted average cost of capital. What's that going to be used for? Well, logic would tell you that's now going to be used for your discount factor in your net present value calculation. So again, pretty straightforward part of the question. For 7 marks, 12 minutes, with a little bit of practice and practicing similar questions like this, calculating the weighted average cost of capital should have been relatively straightforward. If not, I would suggest you go through this question, then put all the videos away, start the question on a blank CBE template tool, do the question, compare it to the solution, and make sure you keep practicing until you get that right. And that applies to everything in this question. So now we're going to move to Appendix 2, which is the net present value of Flotland project. So we're provided some information and some key information, and this is in exhibit number 3. And again, think about your exam strategy. There's not too many windows open. I'm using the spreadsheet right now for all my inputs. I'm keeping my exhibits on the right-hand side. It's all very neat. It's all very one-for-one. Just think about your strategy, and it's really important that you practice this. I've just put from question here just as a little bit of a guide for you. You don't need to put this in the exam. If you do, it's okay, but there's no need to. So when we're calculating our net present value, what do we know? And it should be a layout from looking at the information provided that you're used to seeing. So we have a revenue. We know we have to remove our total costs, which are negative. We know we have our tax allowable depreciation. And then we have a cost of a component, which we'll come to in a second, giving you your total taxable profit. We have tax. We need to add back our tax allowable depreciation for our cash flow. We have an investment with a residual value. And we have to give us our total. Then we have to convert it to dollars. There's an additional part of the component. We're going to look at our extra tax in order to calculate our net present value. Okay. Now let's have a look at some of the component or some of the workings. And the first working we're looking at our component. So what do we know about the component? And again, this is a section in the question. We read through this, how the new factory is a fixed price of 50 cents per unit. So we know the number of units provided, or the number of units to be sold. We have them at the very top, so 10 to 12 million. We have our fixed rate. Then we have, so our fixed price here gives us, we know we calculate our exchange rate. So what's our fixed price? We need to calculate our price in the FF. We have our total cost, and then we have the total contribution. So remember, in your cash flow, you have to take into account the total cost of your component to calculate your taxable profit, but there's also profit going back to the company in the case of 40% of revenue earned, and we need to take that into account. So first of all, we're going to look at the part with the FF million. So we know the 10 million, we know our fixed price. But what we don't know is we don't know our exchange rates. So if we look at our workings on exchange rates, we're going to be calculating those exchange rates using the purchasing power parity theory. And again, that should have been spotted because you're provided your spot rate and you're provided inflation figures. So if we line these up, we have our spot rate today of 4.25. We have our Flotland inflation numbers, and we have our Meydonk inflation numbers. How are we going to calculate our exchange rate? Well, our exchange rate is going to be, and let's do the first one. We're going to say it's 1.05 divided by 1.06. Okay, so 1.05 is 1 plus the 5%, plus 1.06, which is 1 plus the 6%. So it's the Flotland inflation divided by the Meydonk inflation multiplied by 4.25. And we'll just tidy this up, giving you 4.21. I'm just showing you that as an example of how that works. Again, in my calculation, I've linked all of these up. In case you notice mistakes with your inputs later on, you just have to change it. So it's 1 plus the 5% divided by 1 plus the 6% multiplied by the 4.25. The initial part of the calculation is exactly the same for future years. So it's 1 plus the 4% divided by 1 plus the 6%. But instead of taking the time 0 or today's rate for time period 2, we are going to take the rate at the end of time period 1. So instead of multiplying it by 4.25, it's multiplied by 4.21 and so on all the way to time period 4, where it's 1.02 divided by 1.04 multiplied by 4.09. And if you notice the trend, the Frontland inflation is lower than the Maydonk inflation. So therefore you would expect to see a trend of the currency going down as it does from 4.25 to 4.01. Now again, when we go back up to the top here, we can do the cost of our component. So the part we were missing was the exchange rate. Again, I have them all feeding in really nicely. Again, if you noticed anything, it's a really great way to use a spreadsheet much quicker because I can just press equals here. I can link in the 4.21 and then I can just wait till there and drag all that across. And again, it's really good if you notice a mistake in, let's imagine you got your inflation numbers the opposite way around and you realize that later. You just have to fix this and then this will update, and it'll also update if you feed it into your net present value calculation at a later time. So your price in FF is the fixed price of 50 cents divided by or multiplied by 4.21, which is 210. And again, I'm using formulas all the way here so you can just drag them across so they're consistent. The total cost in FF millions is your 10 million units multiplied by your price of 2.1, which is 21.05. If you go back to your net present value calculation, I'm feeding in the cost of the component here, giving you your taxable profit, allowing you to calculate your proper tax. You've added back your tax allowable depreciation. If it's a negative before your taxable profit, which it should be, it's going to be a positive because you're adding it back. You've taken into account the investment and the residual value, giving your total in FF millions. Applying the exchange rates, which we've already calculated. So you see the exchange rates are popping up a few times and they'll pop up again in a minute. So the importance of those exchange rates is really key here. So you're converting, for example, your 200 million divided by 4.25, giving a negative 47 and so on across. Again, you're feeding in your component cost of 1.4, which again is, we look here, it's the 10 million units multiplied by the 50 cents per unit, multiplied by 0.4, which is the 40% of revenue earned, multiplied by 0.7, because you're putting the contribution after tax. So you have to reduce that contribution by the tax. Otherwise, you're not actually paying the tax on it. So it's the equivalent of putting the full component cost before tax. But again, remember the tax rate is 30%, not 10%. Then finally, we look at our extra tax payable, our taxable profit. Again, I can't stress the logic of feeding in everything. So linking, so you can see this is linking to C28 and pulling them across. Your exchange rates, again, used again. Your taxable profit, which is your taxable profit in FF millions, divided by your 4.21, giving you your 450 and the same across. And then the extra tax payable, so it's 30% tax in Maydonk, it's 10% tax in Frontland. So therefore you have to pay that taxation difference, which is 20%. So your taxable profit is the 450 multiplied by 0.2 or 20%. And again, you're feeding that in here as a negative because obviously it's taxable, so it's reducing your cash flow. Then you calculate your free cash flows, which is your converted dollar amounts plus your component and net of your tax. We've already calculated our discount factor of 9% up above. So Now we're able to take our discount factors from our present value tables, multiply our 6.93 in this case by the discount factor, and so on across. And then the sum of all the present values gives you a negative 1.51 million. And you shouldn't be surprised at this because you've kind of already introduced this in part A when we talked about how a negative net present value might necessarily mean that the project will definitely won't go ahead. No explanations needed, no narrative needed. It's all about calculations. So you have all of your workings nice and neatly. You've linked everything up together. Now, the final part that we're looking at is the follow-on project. Now, this is where the directors have looked at the investment in Clunish, and they've noticed that it's benefited from follow-on projects. And if a further investment of 10 million in nominal terms after 4 years could enable the company to generate the tax-free cash flows, again, in years 5 to 8. We have the volatility or the standard association associated with these cash flows has been estimated to be 20%. We already know in our response option, we have our BSOP or our Black-Scholes calculation here. And we have a number of inputs to be included. Now, again, I have put these in red just to show you now you don't need to provide this. But what are your inputs? Well, for the Black-Scholes option model, what first thing we have to do is calculate PA. So what is PA? So this is the cash flows generated from the follow-on project. We see here the cash flows are in dollars for years 5, 6, 7, and 8, and we're provided those numbers. We go into our discount factor tables for 9% because that's our rate that we calculated earlier. We get the discount factors for those tables. And we calculate our present value for each year. And then our present value of future cash flows is 14.16 million. So now we have our PA. And our PA is 14.16. Oh, over in this one, our PA is 14.16. Okay, what is PE? So our PE is 10 million, and again, that's the number you're provided in the scenario, which is the initial investment. So it's 10. Or is a risk-free rate of 3%. Again, that has to be represented as a number, so it's 0.03. T is the time, so T is the number of years, so it's 4 years. And then S is the volatility, which we're given as a percentage of 20%, which is 0.2. And now we see here that we've got our values, our D1, D2, ND1, ND2 values, your call and your put option. Again, these should be values you're very familiar with. If we look here, now what do we know? We know that the value of the call option is 5.55 million. The value of the put option is 0.26 million. So we now know that the call is the best option for this case. That's your only requirement for using your Black-Scholes model. You can close that down. And again, it's a step forward by ACCA. You don't have to do a lot of the calculations yourself like you used to, because there are plenty of models available in real life, and ACCA are doing their best to replicate that in the exam when and where they can. So there are all of your calculations done. Now we don't need the exhibits really anymore because we have our template ready. So now we're going to take into account discussing all of the parts that we need to do for our report. So what is the report? Well, it's to the board of directors for the rank company. It's from the financial manager of the company. The subject is a frontland investment. This is where you're just building up confidence with your examiner, and you're building up professional marks. You start off with an introduction. The report considers whether the frontland investment should be undertaken based on a calculation of how it's valued both before and after taking into account the potential follow-on investment. As part of the assessment, a discussion of the assumptions made and other relevant factors is provided. So first of all, we're going to talk about some of our calculations in our spreadsheet. The cost of capital is 9%. Again, we have that's in Appendix 1. The net present value is a negative 1.5 million. Again, we have calculated this down here. before considering the follow-on option, which we looked in Appendix 2. However, when the value of the follow-on option is incorporated, the strategic net present value of the project is 4 million positive. Where do we get the 4 million positive from? Well, remember when we used the Black-Scholes model, the value of the call option is 5.5 million minus the 1.5 million, which is the negative net present value. This suggests that the investment should be undertaken subject to consideration of the other factors that I have identified below. Now you're asked to, in your requirements, discuss the assumptions made and any further factors. So assumptions made. So there's a number of assumptions on a cost of capital calculation. In calculating the cost of capital, it's assumed the competitor company Clunish was a suitable proxy. There's no guarantee that this will be the case. They might operate slightly differently or in a slightly different sector. It was also assumed that the gearing will stay constant after expansion. This will not be the case. Even if no new finance is raised, a new positive NPV project will create shareholder wealth and therefore increase the value of the equity. So the gearing can't stay constant. Then finally, it was assumed that Geraint's credit rating will remain the same and the credit spread associated will be constant. Again, this is unlikely to stay the same, so the 55 basis points shows that the debt is not risk-free because the risk is that the 55 basis points might change. Then you look at the assumptions around the net present value calculation. There's lots of forecasts, units, and investment. There aren't any workings, so it's difficult to assess these with more detail. And then expanding into a new country or market can be very unpredictable. So it's unlikely that all of these forecasts will turn out to be correct. The transfer price of the component is given fixed at 50 cents, and this assumes it's acceptable because of the arm's length transaction between two companies in two countries. The tax rates are assumed to be constant, and they might change if the fiscal policy of the government changes. And again, the tax level depreciation figures are given with no explanation. And again, this is just a case of going down through your calculation and really going to go, do I believe that? Is that true? What makes me want to believe that? Do I have any doubts? And you're explaining the doubts in your report. The spot rate of the exchange was given and assumed it had been picked from a reliable source. It's assumed that the exchange rates would be according to the purchasing power parity theory. It's unlikely that inflation alone will impact exchange rates over time, and again, there'll be other macroeconomic factors. And there's no guarantee that the forecast inflation rates will turn out to be correct. When we look at using the Black-Scholes option pricing calculation, when we look at the value of the follow-on project, it was assumed that the risk-free rate and the volatility will stay constant. Also, when using the model, the assumption is the project cash flows are normally distributed, and that might not be true as well. And finally, there's no workings given to show where the investment figure or the future free cash flows have been derived. If there are errors in the estimates, it'll have a big knock-on impact. Now, the second part that you have to think about is the other factors to consider. Frontland has a different currency and it might be a different language, etc. Geraint will need to make sure it understands the impact of these things. Investing will expose Geraint to political risk, and the government will change, tax rates might change, there might be restrictions, there may not be a taxation agreement, lots of things can happen because of political risk. There could be ethical and environmental issues investing in a different country, there could be different rules to do with wage rates, lots of different things could have an impact from moving from one country to another. And then the original calculations considered a follow-on option, but there may be other real options, such as the option to abandon. And if those real options can be identified, it would make the project more appealing because it would show that more consideration has been given. Finally, your conclusion. And again, the conclusion, not from a marks perspective, but from a professional marks perspective, and just from sending a real message to the examiner that you're really in control of what you're doing. The strategic net present value of the Frontland project is positive, so the project is financially viable. But before making a decision whether to go ahead, there are lots of other factors, and we've discussed them. The calculations were based on assumptions, so a sort of sensitivity analysis would be useful in order to investigate that further. So you are saying yes based on the numbers, but you're saying yes, but a little bit of work left to do before you push the button and definitely go ahead. So again, go through the calculations, use the video, pause it when necessary, Try and recreate this yourself in your own answer without using this answer, and then maybe side by side go through it. Make sure you understand everything, and best of luck in any future exams you're taking.